Welcome, grade 12s. Yes, you are with Ashraf Patel for the accounting slot. And remember, today's lesson is about inventory systems. And with regards to inventory systems, remember, important for you is to establish what do we mean when we talk about inventory systems. And then you will notice that we will also talk about stock validation, but more about that later. Let's start with the key concepts. Whenever we talk about the types of inventory systems, you would find that generally we use two stock systems. What are they? And yes, these two systems are items or systems that you have covered in grade 11 already. So there's nothing new to this. All it means is we need to revise it so that you understand what system is being used and obviously the advantages and disadvantages of each system. So the two systems are the periodic system and the perpetual system. Now, obviously, both these systems are examinable. In other words, you need to know now that these two can appear in any of your question papers across the curriculum, depending on where it is being tested. I want you, for the next minute, just jot down ideas on the perpetual inventory system and the periodic inventory system, just to see how much do you actually remember from your grade 11 work. Go for it. Welcome back, guys. Let's see. Have you mentioned these pointers? Let's go through it. You find that with the perpetual system, important characteristic, and obviously you've used this since grade 10, when you record the cost of sale with every sale item. Okay, let's just discuss that for a minute or two. In other words, every time a sale takes place, you will also record the cost of sale. This means, therefore, and this is where the word perpetual comes from, a continuous inventory system. In other words, if at any one time you need to know how much stock you have on hand, you will just refer to your trading stock account, and that will give you an indication of the value of stock in your business. What about the periodic inventory system? The main characteristic of the periodic system is that we work out the cost of sale at the end of every period using a formula or given information. So this means that you do not keep a running record of your stock. So that's a key characteristic of the periodic inventory system. Now, clearly you can see that having dealt with both the perpetual inventory system and the periodic inventory system, you're going to ask yourself the question, what are the advantages of using each of these systems? Understand, we are still talking about stock systems. Right, now, a key characteristic of the perpetual stock system is you know exactly how much stock you have or you should have on hand. Why? Because you are keeping a running record of your stock. Clear? Number two, stock losses are easier to detect using the perpetual system rather than the periodic system. In other words, if you take a stock take and you compare that stock take with the actual stock figure as it appears in your trading stock account, you will be able to ascertain immediately whether you have a trading stock shortage or you may also have a trading stock surplus. So this perpetual system lends itself to identifying stock losses much more easier. Then it is a more accurate and realistic as your cost of sales are recorded every single day. In other words, every single transaction will have the sale recorded as well as the cost of sales. So those were your advantages of the perpetual stock system. Now, let's look at the advantages of the periodic system. Certainly, it is used by certain types of businesses, and the key characteristic of the periodic system, which we would classify under advantages, would be it is much cheaper and easier to implement than the perpetual system. Why? Clearly, you don't need expensive scanners, and you don't need to record the cost of sale after every sale item. So, you have clearly seen now that the periodic system is cheaper to run. Obviously, many businesses cannot afford the infrastructure that goes with the perpetual inventory system. You need point of sale machinery and equipment, you need scanners, and therefore it is much more complicated in terms of the infrastructure to have the perpetual system than the periodic system. Also remember that your perpetual system is much more expensive, and therefore you find a distinct advantage of the periodic system is that it is cheaper. Okay, now let us take a look at the periodic inventory account, whereby if we are using periodic inventory, what will my trading account look like? And if I'm using the perpetual inventory system, what will my trading account look like? You have exactly 2 minutes to draft these two accounts. And when you come back, we will go through these accounts and you will see whether you can identify items that need to appear in the trading account of a business that uses the periodic inventory system and the trading account of a business that uses the perpetual inventory system. Go for it. You got 2 minutes to draft that account. Welcome back, grade 12s. Right, let us compare what my ledger account, the trading account, looks like as compared to yours. Let's go for it. Watch. Let's start with the periodic inventory account first. And what is important is for you to understand each of these concepts as they apply using your trading account, using the periodic. We said we're starting with the periodic first, so that's where we're going to go. Right, now, you would start off with your opening stock, keeping in mind that your last year's closing stock becomes this year's opening stock. Then you have your purchases figure. Remember, the purchases figure will always have a bracket assigned to it, wherein you will do all your calculations with regards to purchases. What are we referring to here? We are referring to adjustments that affected the purchases figure. Like what? Like your creditors' allowances, which was your return of merchandise, your drawings, your trading stock that was donated, right? And maybe some errors that affected the purchase account. So obviously, those purchases figures would come from having done your purchases and the adjustments that had affected the purchases figure. And thereafter, would you transfer the purchases account into your trading account. So keep in mind that if there are adjustments, show your adjustments in brackets. Okay. Then you come to expenses on purchases. Like what? You've got your carriage on purchases as an expense. You've got customs duties as an expense on purchases. Now, where do you draw a line? What determines whether the expense is a purchaser's expense or not? Very simple. Every expense that affects the cost price of your goods would form part of your purchaser's expenses. Examples are carriage and purchases, customs duties, import duties, right? Any cost that you have incurred in bringing the goods from the point of purchase to the point of sale, from where we are operating our business, would impact on the cost price of those goods. Be careful, grade 12s, about carriage on sales. Thought about it? Carriage on sales is a selling expense, and therefore it does not impact on my trading account in any way. It's a normal delivery expense. Be careful. You get these red herrings in accounting, and make sure that you don't get caught out by them. So carriage on sales is not an expense that affects purchases. Rather, it's a normal expense that would go to my profit and loss account. Okay, then you bring in your closing stock for this year, and you bring in your sales figure for this year. Okay, and that then, if you add your closing stock plus your sales, because they're on the same side, you can see it, right? Less your opening stock, then your purchases, then your carriage and purchases, then your customs duties, okay? This would then give you what we refer to as the gross profit of 75,000 rand. Okay, then, if you look at the trading account using the perpetual inventory method, simple. 3 items make up the trading account. What are they? Your sales, your cost of sales, and the difference between your sales and your cost of sales would give you your gross profit of 75,000 rand. Watch that whether you are using the perpetual or the periodic, you need to come to the same answer if you are working with the same figures. Right, guys? We've done something very important here with you. Make sure you understand exactly what's the periodic inventory and what's the perpetual inventory. We're coming back to stock validation or stock valuation. You want to know more? The place to be is with us on this accounting lesson. See you in a while. Welcome back, grade 12s. Yes, remember I said, before the break, I said, we're coming back to stock validation, sometimes referred to as stock valuation. Just another word, valuation, validation. Now, let's ask the question, why is it important to have your stock valued at the correct prices? Simple answer. Your stock value will have an important impact on your financial statements. And think about it. Remember, if you look at big enterprises, you find that their stocks run into millions, if not billions of rands. And therefore, you find that stock is normally a large percentage of your total assets. And therefore, in terms of stock valuation, it is key to your financial statements that stock must be valued at net realizable value or market value. Right. Now, when it comes to stock validation, stock valuation, we have basically what you are expected to know for the exams are 3 methods of stock valuation. I'm going to give you a minute just to list the 3 methods of stock valuation with just a little bit of information around each of these methods, right? So I'm giving you 1 minute only. List the 3 methods of stock valuation that you know, just with a little bit of ideas around what each method entails. Go for it. Welcome back, grade 12s. I'm sure you've listed the following, but before we go there, let's ask ourselves, which method do we use to determine our stock value? Obviously, when you're choosing the method in order to determine your cost price of your stock, it's important that the choice that you make must facilitate, and it must be the most realistic determination of the profits for any specific business. Obviously, this means that depending on the enterprise that you are dealing with, the nature of the stock item will determine which method of stock valuation you will have to use, right? Let me repeat that. The nature of the enterprise will determine the method of stock valuation. Now, let's see. They talk here about the 4 methods, but I said you will only be examined on 3 methods for the exams. We'll mention the 4th one, but obviously we won't discuss it because it's not examinable. So, the first method that we will be dealing with is what we refer to as specific identification method. Now, very simple. Let me draw your attention to the following example. If you have 3 BMWs parked as your stock, a 3 Series, a 5 Series, and a 7 Series, okay? Now, obviously, each of those items, each of those vehicles has its distinct cost price. A 3 Series has its price, the 5 Series has its price, and the 7 Series has its price. What do? We go to each item, we identify the item, that's a 3 Series, this is its cost price, and that's how we record its cost. What have we done? We have specifically identified a particular product, and based on its cost price, we have recorded the cost. Okay? That's just a broad explanation on specific identification method. Then we have what we refer to as the weighted average method. Weighted average tells you that you take into account the total number of units that you have purchased, as well as the values of those units. And obviously, when we say average, it means you find the average of 1 unit, okay? And then you multiply it by the number of units that you have left over. Again, broad explanation. Thirdly, you have what we refer to as the first in, first out method. The acronym for it is FIFO. first in, first out. Very simple. The stock that comes in first is the stock that is sold first. Right. So now, when we said 4 methods, there is also a method called LIFO. Last in, first out. Obviously, this one is not examinable. It's not accepted by SARS, and therefore we do not examine it, so you are not expected to know that method of stock validation. So the methods you are supposed to know are your specific identification, your weighted average, and your first in, first out. Okay, now let's go into a more detailed explanation. Specific identification is nothing new to you. It should not create any problems for you as learners. Why? Because we have been using this method in grade 8 to grade 10, where the specific cost price of an article is provided either in rand terms or in code form. What do we mean by this? We mean that on the article, you would find the cost price denoted in some kind of code formation, right? You remember you've done this in your earlier years of study. Maybe when you studied EMS, we spoke about the secret code which you use for your cost prices. This is exactly what we mean here. So the bottom line, what you need to know is that every item has its own unique cost price, and every item is specifically identified, and the cost of that item is then recorded accordingly. Right. When it comes to weighted average, the weighted average method does not take only quantities into account, but the average price is taken into account. In other words, every time there's a receipt of goods, it means every time we buy goods, the average cost of each item is recalculated, right? Also, this means that you could calculate your weighted average at the end of your financial period. So, if we want to take that and illustrate by means of a simple example, right? If you bought 10 items at 5 Rand, it will give you a value of 50 Rand, clear? Then you bought 20 items at 7 Rand, that will give you a value of 140 Rand, okay? And then if you bought another 5 items at 9 Rand, that would give you a value of 45 Rand. So, when we're talking weighted average, are we only looking at quantities? No, we're not only looking at the quantities, but we're also looking at the value. So in other words, we want the weighted average. So we add 20 plus 10 is 30 plus 5 is 35 units, right? And the cost here will be 235. Right, what do we then do? We say, fine, let's take our calculator, and we say the value was 235 divided by the quantity, which is 35, to give me a figure of 6 Rand 71, and therefore 6 Rand 71 is what we refer to as the weighted average. Now, an important feature of the weighted average is that, note, not one of these items actually cost us 6 Rand and 71 cents. Why? This lot cost us 5 Rand, these items cost us 7 Rand, and these items cost us 9 Rand. But the weighted average of these items is 6 Rand and 71 cents. Okay. That's what we mean by the weighted average. Let's go back and look at the next method. We refer to it as the FIFO method. The sale of goods is based on first in, first out basis, right? That is, your goods that are bought first are the goods first to be issued for sale. And yes, you know, Ashraf always has his tricks about him. The secret to FIFO grade 12s is bottom up. Please listen carefully. I said bottom up and not bottoms up, eh? I said bottom up. What am I referring to? When I say bottom up here, what am I referring to? Let me give you an example. If I bought in January, I bought 15 items at 100 Rand. We're not going to do the values. In February, I bought 40 items at 110 Rand. In March, I bought 10 items at 120 Rand. Okay, let's assuming that March was the end of my financial year. And if I told you that my stock is now, I'm left over with closing stock and I'm left over with 25 units. Okay, I'm left over with 25 units. Remember, I'm using the FIFO method of stock validation. Now, very simple. With FIFO, what did we say the secret was? Or what is the secret? The secret is bottom up. Watch. If I'm left over with 25 units, which 25 units do I have left over? Clearly you can see these 10 units that I bought in March are left over. So you start off with the 25 units and you've accounted for the 10 units that are left over. That means you must still account for a further 15 units. Right, so these units are definitely left over because they were bought last. Do you see that? Now, because they're insufficient to cover the number of units which we require, which is 25 units, what do we have to do? We now have to go up. Remember, bottom up. So now we go to the next lot of units. But those are 40 units. We only need 15 of those units to take into consideration. So in other words, we have 10 units left over here, which were bought in March, and we have 15 units left over, which were purchased in February. So now, this total year would make up your 25 units that you need to account for in terms of your closing stock. So therefore, grade 12s, you can clearly see each of these stock methods have certain unique characteristics that you have to look for. If you recall, we said specific identification, go to specific items, and again, the question arises here. Can you use all of these items for any stock item? Remember, we alluded to this in the earlier segment, and we said the nature of the enterprise, the nature of the stock item would actually determine which method of stock you have to use in terms of its validation. A classic example, if you take motor vehicles, right? So, let's just do this by way of an exercise for you. Take the item motor vehicles, right? Take the item golf clubs, and take your golf balls. Right. I want you to assign each item here to a specific stock validation method without repeating any of the methods, right? You've got a minute to do that. That means take the stock item and say, right, which stock item am I going to, which stock validation am I going to use for motor vehicles, which one am I going to use for golf clubs, and which one am I going to use for golf balls. But you can only use the stock validation. Each one you can only use it once. You got a minute. Go for it. Welcome back, grade 12s. Yes, this is what obviously you can interchange, but ideally this is what we would use. Motor vehicles, definitely specific identification method. Golf clubs, obviously we're going to use first in, first out. And for golf balls, the most appropriate stock validation would be my weighted average. Okie dokes. Guys, we've done stock systems, we've done stock validation. Now we go to a question. So if you want to see how we're going to apply this to a question, take a quick break and we'll see you in a jiffy. Welcome back, grade 12s. Okay. We said we're going to put into practice what we've seen or what we've dealt with in the first two segments. The question says, the business uses the following methods to value the stock of watches. One is your jocks, and it uses specific identification. Quartz, it uses weighted average. It tells you specifically no watches were stolen or lost during the financial year. Here's my information with regards to jocks watches. We also know that the price of your jocks watches include the transport costs and the customs duties. In other words, they are included into the cost prices, and these watches are sold at a markup of 75% per annum on cost. Okie dokes. Now, what is it that we need to calculate? We now need to calculate the value of stock of jocks watches on the 31st of August 2015. Okay, let's look at the information. What do we have? Of my opening stock, I had 12 units, of which I sold 11. Remember, we're using specific identification method. So now we're identifying these watches and we're saying that of the 12, we sold 11, we got one watch left over, 6,500. So immediately I say 1 by 6,500. Okay, let's go back. Next item, we had 15 of these units that we purchased, of which we have sold 10. Clearly you can see that you have 5 left over. 5 at what price? 6,800. Therefore, we're saying 5 at 6,800. Okay, then we go back and see the next item that we got to deal with. The next unit price is 7,300, and these units we had purchased 12, but we've only sold 10, meaning that you got 2 left over at 7,300. So we said 2 units at 7,300. Can you see what we are doing, grade 12s? It's a specific identification. That means you're going to each unit and you're saying, right, how many of these units are left over? How many of these are left? They're all Jock's watches, but they were purchased at separate times. And you now have to specifically identify them in order to arrive at the value for your closing stock. Okay, then we had the last one. We had purchased 8 units, we had sold 5 units, that means we had 3 units left over at 7,800, therefore 3 units at 7,800. What do we do now? Obviously, we take the values into consideration. That will be 6,500. 5 at 6,800, let's do that. 5 times 6,800, 5 times 6,800 will give me a value of 34,000. So there's my 34,000. Then we had 10 at 7,300, which will give me a value of 73,000. Let me just check that one out, because let's just see if we got it correct. Nope, so we definitely got it wrong. Can we see here? Let's just check here. We had sold 10, but we purchased 12. So we had 2 at 7,300. So we've got an error here. Let's correct our error. It's supposed to be not 10, but 2 at 7,300. So let's erase that. You see how important it is to check your work? Very important to check your work. So therefore, it's 2 at 7,300, which will give me 14,600. And we had 3 at 7,800, which will give us 7,800 times 3 is equal to 23,400. Therefore, take your values now and add them up. Obviously, that would be the total value of your closing stock. Now, what was important for you to see in this particular calculation here was the fact that you had to specifically identify which stock item was bought and sold to determine what you have left over. Okay. Then we had to calculate the sales. I think we're working in the wrong place, but anyway, we can adjust our answer book. This was for our Jock's watches. It's just that we're working in the wrong answer book, but that's not too serious. As long as we know which watch, we're dealing with the Jock's watches here, and therefore, that was what we had to calculate. Right. The next question regarding our Jock's watches was, calculate the cost of sales of your Jock's watches for the year ended 31st of August 2015. We will start off with our opening stock, right? And our opening stock of Jock's watches was opening stock 78,000 Rand. Remember, that came from 12 units at 6,500, gave me a value of 78,000 Rand. Therefore, opening stock 78,000 Rand. Okay? And then what we have here is the total purchases for my Jock's watches would be 252,000. So immediately what we say is, let's go to that figure. 252,000 is my purchases figure. So in other words, when we're determining the cost of sales, we are saying it is your opening stock plus your purchases. Remember, we dealt with this. And all your expenses on purchases. But what do we know? We know regarding Jock's watches that all the costs, that means your transport as well as your customs duties, were part of the purchase figures, and therefore they were included. So therefore, what we're going to do now is take our opening stock plus our purchases. We're going to add those two components together, and then we're going to subtract our closing stock from it. Once you subtract your closing stock, you will then be left with your cost of sales. So, in other words, what is important for you to remember? Remember, if we have to summarize today's lesson, we would say 1, look at your stock systems, whether you're using perpetual or periodic. Number 2, look at your stock validation. Are you using specific outcome? Are you using weighted average? Are you using your FIFO? Once you've determined that, once you have an understanding of that, I promise you guys, in this section in the exams, it's an A for away. So, from me, Ashraf, from our crew, James and AB, have a stunning one. Reach for the moon. If you don't get there, definitely you're an accounting shining star. Until the next time, be good.